And there's a tiny bit of housekeeping. Let's give it about 30 seconds, and then we'll begin. Right, well, we'll get started. And hopefully a few more people are joining us. I can see they are as we go. But we said it was 12:30, and so we will be punctual. Welcome all of you. I'm Andrew Lance. I'm the Chief Investment Officer at Simplicity, and I'm delighted to introduce to those that don't know him already, Shamubeel Eaqub, who's a highly respected economist and commentator on the New Zealand economy and market. Some people don't realise, but Shamubeel was with us at our earliest stages when we first formed as a director, and he's rejoined us very recently. So I'll leave Shamubeel just to quickly introduce himself.
Thanks, Andrew. Look, I'm delighted to be here today. I'm the new Chief Economist for Simplicity. I joined middle of October, and my work plan is going to be pretty big, a lot around what's happening in the economy, but a lot of my effort will be focused on how can we improve KiwiSaver for New Zealanders going forward. So really, really excited to be here.
That's great. Now, just to we've got a few slides to quickly go through. What we'd like to make it is about as informal as possible, and respond to questions is the ideal way I like to run these. So if we could just remind you, if you have got a question, happy to put your hand up. We will try and work out how that works. But better is to work it through the Q&A. Down the bottom of the screen there. If you've got a question, please ask away, and we'll respond as best we can. But I might ask you, Cheryl, to do the important job of starting the slides.
Sure thing. Here we are.
Great. So, just really running through what's been going on. A little bit of context, I guess, of the last few months, years, etc. I've just put up some of the fund performance as has been. These are what we call the diversified funds. So these are the funds that are invested across a whole load of different asset classes. And as you can see, the 1-year returns are, probably does just about qualify as spectacular. Even the conservative funds has returned well over 13%. The longer term returns for some of these are not quite as good. The growth fund, probably 8% actually after fees is about what you'd expect from a growth fund for that sort of period. It's really the conservative fund that hasn't performed as well over the longer term. And that's due to changes in interest rates as we've discussed many times in the past. The specific funds here, the diversified, the sort of non-diversified, sector specific, sorry. And you can see there the New Zealand Bond Fund for the last 5 years, it's still in negative territory, which is pretty shocking, really, for what should be a very safe fund. But again, the 1-year returns from those, particularly those two share funds, is spectacular, and very unusual for returns to be as very strong as that over that sort of period of time. So just to give a little bit of context of where we've got to, I like to just look at that long term. This is 10 years of history, and you can see that bonds have recovered nicely since 2022. This is an index of values, if you like. So since October 2022, the bond market has overall been reasonably strong, but it's only performed about as well as risk-free cash over that period. And actually, over the last 10 years, if you've been invested in 90-day bank bills, which is virtually risk-free, you'd have the same return as you would out of either a global bond fund or a New Zealand bond fund. And then for shares, the numbers are a great deal higher. Should sort of put some context here as well, but this means that over the last 10 years, your money in let's say, take the top one of those hedged global shares, has pretty much gone up two and three quarter times over that period. So it's a very strong period of returns. And again, you can see since October 22, a really nice run up for markets. The New Zealand share fund actually over that time, or the New Zealand share market over that time, has not performed anywhere near as well as international markets. And I can demonstrate that again if I just show the 1 year returns here. You'll see New Zealand shares is this dark line down the bottom, the one moving a wee bit, but down the bottom. International shares have done considerably better. And in fact, the New Zealand dollar has been relatively steady over this period as well. It's not on here, but the fact that unhedged and hedged global shares has performed very similarly over that time is indicative of the fact that the New Zealand dollar has been reasonably steady. So that's my sort of background spiel on markets. I will pass over to Shamubeel to cover the economic backdrop.
Thanks, Andrew. I just thought I'd give you just a little bit of a potted kind of take on what's happening in the economy right now. And the reality is right now we are still in recession. And you can see that on the picture on the left-hand side, that's New Zealand's GDP per capita. Roughly speaking, what that looks at is how are New Zealanders doing on average. And you can see around the GFC, 2008, 2009, the pink area, we saw that reduction in people's prosperity. We've seen that again this time around. And the forecast from the Reserve Bank is there's still a bit more to go before it turns around. The thing that has actually been very different in this cycle compared to other ones that I've been involved in is it's been more of a business recession. So far, we haven't seen lots of job losses or income reductions, but what we have seen is massive reduction in profits. That's part of the reason why we have seen the high number of insolvencies and things like that. It has been a very unusual recession. So it's not to say that people aren't hurting at home, but more of the brunt of this recession has been about businesses and business profits. But we're starting to see some positive signs coming through. So the way I think about it is optimism is a necessary but not sufficient condition of an economic recovery. Over the course of the last 12 months, we've seen businesses and consumers feeling like things will generally get better. So on the left-hand side, you can see the businesses saying, in the next 12 months, surely things will get better. And the green line shows you that actually things haven't been that so good so far. But as we start to see interest rates coming down, as we start to see some of those other things coming through, we should start to see the economy recover because that optimism is there. Once businesses see the real kind of measures of economic recovery, they will start to invest and hire again, and that will be the bit that will come through. And the right-hand side, you can see what's happening with households in the green line. That's households telling us, my financial situation is feeling pretty tough right now. And that's not surprising, right? We've had all that inflation. We've seen prices hanging up at high levels, and that's really affecting people's ability to get on. But people are hopeful that we'll start to see the labor market improving next year and their incomes will improve. And you can kind of see that in the data. On the left-hand side, you can see the unemployment rate in New Zealand. It's ticked up in the last little while, but from very low levels. And the current rate is still quite a bit lower than it was during the GFC, and certainly a lot less than the previous crises that we've experienced. But on the right-hand side, I think is probably a more telling picture of why people are feeling cautious. Both businesses and households are feeling cautious because there are very few job ads out there. And that's a reflection of businesses just not being confident to advertise jobs and hire people. And similarly for households, it means that if they want to move jobs, move careers, progress, it's very hard to do that right now because those job vacancies are not available. And so that vacancy rate is something that I look at really closely because it's one of those really important enablers of an economic recovery. And right now, that's still telling us that things are pretty tough. It's not getting worse, but it's not yet getting better. A little bit of why people are feeling quite glum right now. So a recession is not necessarily about things going backwards or businesses failing. Those things do happen. But the reason why it happens is people just feel like they can't take risks. People feel like they're not getting ahead. It's a collective sitting on hands. And you can kind of see what has happened over the course of the last couple of years in these two pictures. On the left-hand side is real wages, so incomes after the cost of living. And you can see that the first year of the COVID years, we were just grateful to have a job, so we didn't get a wage increase. And then we had the burst of inflation and wage increases got eroded very quickly. And the effect of that is on the right-hand side. The average spend per person in New Zealand today in the retail sector is back to where it was in 2013. And it's a very uneven effect. What we're seeing is some households are doing it really, really tough. One kind of measure I look at is what kind of things are people buying. Typically, 80 to 90% of families will buy fruit and vegetables in any given week. Last year, it was 60%. So that level of poverty, the impact of inflation is hurting more people, and there is a lot of pain out there. I'm starting to get more optimistic about the economic recovery, but there's a little bit of hard stuff to work through over the next 6 to 9 months. One of them is from net migration, because population growth and net migration is just a really big boost for New Zealand cycle. And as you can see on the left-hand side, net migration was very strong, and over the last 6 months has really slowed a lot. And the other part that's a bit of a risk for us is fiscal austerity. So this government was elected on the back of a promise for tax cuts and spending cuts. Both of those things are coming through. And in the course of the current financial year, the government will be sucking out something like 4% of GDP. So these things have to work their way through before we see the economy recovering. And in the backdrop, this is a very busy picture. On the backdrop is still quite a bit of pain in the global economy. This is PMI, the performance of manufacturing index around the world. And you can see that across most of the world, things are kind of just holding on or are going backwards right now. So our trading relationships, our trading partners are also doing it relatively tough. So we're waiting for them to also recover before we see our exports doing really well, before our domestic economy also recovers. So there's a little bit of that synchronized kind of weakness that we're seeing somewhere in other parts of the world. But there's also a little bit of divergence and convergence that we're seeing. And the convergence is really around that experience of inflation in recent years, which has eased. And I'm pretty confident that we won't see that picking up in a big way in the next 3 to 6 months. Same with interest rates. You can see that they fell very sharply during the COVID years, and they rose in a synchronized fashion because of the inflation, and they're now starting to come off. But in the next year, we're probably going to see a bit of divergence coming up, and that's probably because of relative strength of the US economy. While the manufacturing sector there is weak, consumers are holding up really well, and the domestic economy is holding up really well. There's been an election there, and there's a lot of uncertainty about what kind of policies will come through there. So with the Trump presidency, I think there is not a lot of certainty around what specific policies will get through. There's probably a 4-month hiatus before people are appointed and all those bits and pieces. So watch for that space. What I'd like to remind you is that presidential terms have no bearing on market returns historically, but it doesn't mean there won't be a big effect on geopolitics, politics, and policies that might be pursued by the new administration. So there's a little bit of uncertainty and stuff to think about over the course of the next little while. But when I look at the current low inflation and falling interest rates, further interest rates to come in New Zealand as well from the Reserve Bank, we are starting to put in place the preconditions of an economic recovery, which I hope is going to begin in the middle of next year. So still a little bit of pain. The economy is still doing it tough, households and businesses too, but pretty confident by the middle of next year, we'll start to see some good stuff taking place. So I'll stop there, and I think we'll open it up for the Q&A.
Yeah, fantastic. And we've already got a couple on there. Let me get this up. Oh, okay. Sorry, we've just read that there was something wrong with our slides. Hopefully fixed. The Simplicity Living, this is an anonymous attendee. The Simplicity Living investment now sits between Apple and Nvidia in my high growth KiwiSaver. Is set to grow to 10% of the whole portfolio. How can I see how my investment in Simplicity Living is going returns wise? Very, very good question. And that's something we will need to definitely address, because it's clearly it will become an important part of your portfolio. So I'll take a note now that we will publish the returns from Simplicity Living, or the investment in Simplicity Living, on an ongoing basis. I know what we project to return out of that investment, which is extremely attractive over the very long term. It's more like an index-linked bond, but in the immediate future, the returns should be more than everybody should be more than happy with them. But we'll address that one. Next question. Hello. Currently, members are getting returns solely by fund unit prices which are visible when log into the app. With the investment to startups and purchase of businesses, etc., Stablecraft, how will these returns be itemized and shown to each member? Media states it's a private equity fund. Is it a new fund product? Oh, great. Okay. Well, I mean, it's actually, in a way, a very similar question, because from your point of view as investors, it's very difficult for you to see what we're generating out of the property fund, which is Simplicity Living, the private equity fund, which is the private equity portfolios. Again, both portfolios have been doing very well, and so you will be happy with the returns. But I'll have a word with our web design people and get a way of you seeing exactly what we're getting out of those investments. They're still very small. Even Simplicity Living, actually, in the bigger scheme of things, is still a very small part of anybody's investments right as we speak. But in time, it will improve or will increase. And I understand that you'd like to see that. Next one, and I'm very pleased to say this is one for Shamubeel, not me. Do you think there will be more job cuts to come in the new year, or is that pain kind of over?
Yeah, look, I think we are going to see some more job losses, and that's going to come from two things. One is around businesses still rationalizing because of those low profits. So what we're seeing is businesses are one big cost that businesses can cut is labor costs, and we're seeing that at the margin. The other is going to be from business closures. There's still a bit of business closures to work through the system. There are a lot of businesses that have been hit really hard by the current recession. So my expectation is that we're probably going to see job losses accumulate until probably around March of next year. And after that, we should start to see businesses getting ready for the recovery and really holding on to people. So yes, things are still a little bit tough out there, and probably just a bit more pain before we turn the corner.
This is great. Now, more for you. Do you think the housing property prices are going to get more favourable for first-home buyers, or will it start going up again?
Yeah, so there's two conflicting forces at work right now. The first is around the very beneficial kind of effect from falling interest rates. That's kind of giving a lot of interest. Banks are starting to lend more, so there's more money available that's becoming more affordable. But on the other side, we've got net migration that's coming down. Historically, when population growth is weak in New Zealand, the property market does weak. So we've kind of got this conflicting forces right now. And because of the weak labor market, it's probably a bit of a holding period for the next 6 months. And so if you're a first home buyer and you do have the money available, this is a really good time to be looking, because there's quite a lot of stock available. But like anything, make sure you get good financial advice, get good advice on mortgages, because it's always very property specific when it comes to markets and your own individual financial situation.
Great, thanks, Shamubeel. I've heard that inflation has started creeping up again in the UK. Is that a major risk for New Zealand?
Yeah, look, really good question. And part of the reason why the inflation rate has picked up in the UK recently is some of the subsidies on energy has come off. So those energy costs are going up and inflation is picking up. The reality is that inflation problems around the world are not completely resolved, but they're not nearly as high as they were. So we'll see some lingering inflation hanging around in that 2.5% mark, rather than 2% mark, which is the Goldilocks zone for central banks. My sense is that the relative cost of 2.5% inflation versus 2 is very little. And if the Reserve Bank was trying to squeeze out the last 0.5% of inflation, that would lead to a lot more job losses and a lot more business closures. And quite rightly, that's not the tack the Reserve Bank is taking. And that's why I think the Reserve Bank will continue to cut interest rates, even though there is still some lingering inflationary pressures. But now they're focusing very much on how do we make sure we look after the people and the businesses in the economy? Because if we don't, we'll kill inflation, but we'll also kill the economy.
Great, thank you. This is an interesting question from Ange. I am one of many females and friends aged between 60 and 65, but not yet qualifying for super. Any vision of how this growing group will be supported with the drive to grow KiwiSaver? You got any thoughts on that, Shamubeel?
Yeah, I think for older people nearing retirement, KiwiSaver is simply too young to have made much of a difference. You haven't had enough time to be able to really save for retirement. So whatever plans you had beforehand, I think are really important, whether it's in your other pension funds, your home and precautionary savings. And of course, you still qualify for New Zealand Super once you reach the age of eligibility. So for those who are nearing retirement, I think KiwiSaver is simply too young to have made a difference. For future generations, I think it's going to be much more important. But for women in particular, I think there is a real inequity that we need to address, and that's because women tend to take more time out of work for children and family than other people do, but also care at older ages for parents and things like that. So what we tend to find is there's a lot more time taken off for care, and as a result, women's pension savings tend to be quite a bit lower than men's. So there's a bit of inequity to work through. I don't think I have a good answer for how we fix that yet, but it's a policy issue that we really need to look at. Now, to give you a little bit of comfort, New Zealand at the moment spends about $1 billion in KiwiSaver subsidies. I don't think we should be doing it the way we are at the moment. In the future, we should be using that to support people who are falling behind or are being unduly falling behind, like women because of maternity and care duties, or for children who are currently being excluded from KiwiSaver. So a bit of policy stuff to come through. Probably not a very good answer for your specific issue, but from a policy perspective, I think one, it's probably not enough for you. It's too young. For future generations of women, it will be better, but we could make it even better if we worked hard on it on the policy side.
As Shamubeel mentioned, one of the reasons that we were keen to get him on board with us is to help drive some of that change for the broader good, and so we're looking forward to that. Next question is in the global hedged fund, how much is hedged? I presume you mean the share fund. But both the global hedged bond fund and the global hedged share fund are 100% hedged. So any currency exposure in each of those funds is hedged back into New Zealand dollars. So there's no currency risk in either of them. Somewhat counterintuitively, what that means is that the hedged fund is likely to be slightly more volatile than the unhedged fund, because currencies quite often offset the moves in share markets. So if you've got no currency risk, you've only got New Zealand dollars, the New Zealand dollar is actually quite a volatile currency, and so it can actually increase the volatility of the fund. But that's just a comment on that. Why is Simplicity not up the top when it comes to long-term performance in the leading KiwiSaver providers, etc.? The Morningstar result, and over 5 years, not in the top 3 for any of the funds. Again, very good question. And we took a decision when we first started out as a KiwiSaver provider now, basically 8 years ago, that we would not, that KiwiSaver was a long-term investment, and that therefore we didn't need to have money sitting in cash. We would put it into long-term bonds and long-term investments. While that proved to be a very good decision for the first 3 or 4 years of our lives, unfortunately for us, we didn't revisit that back in 2019-20, when interest rates basically got down to nearest damn it zero. We carried on with our ethos. We decided that we shouldn't overlay our own views. And unfortunately, of course, what that meant was that interest rates then rose very sharply, as I showed in the slides earlier on in the piece. And so for our conservative funds and for all of our funds, we had more, they call it duration in the market. We had more exposure to interest rates than most of the other funds. Now, if there were 7-year and 8-year tables in the Morningstar charts, I'm pretty certain we would be looking a great deal better, because that looks through that period in sort of 2019, 2021, when things didn't go well for us. But when we are in the 10-year tables, which is now 2 years away, I'm very, very comfortable that we will be right up the top.
Can I just make a general comment, less about the fund performance and more about retirement savings? The amount that you have in retirement is more to do with how much you contribute regularly over time, rather than the performance of your funds. So yes, that matters. But if you look at the total funds under management in KiwiSaver today from inception, 80% of that is because of the contributions people have made rather than the returns of the market. So it's really important to keep that kind of in perspective, that it's your contributions that you're making regularly and consistently over time. That's where the magic of compounding happens. And of course, the performance on top adds to it.
Yeah, that's a really good point. An anonymous question again. Any further fee cuts to come in the new year? It was great when you guys matched kernel, but surely you can go lower. Again, another very good question. I can't say categorically either way, but I would say that probably for the next 12 months at least, no, we're not likely to cut fees markedly. I know Sam would like to, but one of the consequences of the growth that we've seen in our business is just that we've got to make sure that we can still provide the best possible service to our members, and in doing that, we just need to be very careful of keeping our costs as low as we can. But it still means that we are having to spend a little bit more on things like our investor services team, making sure we're on top of our technology team. So I would say that right here, right now, we're more likely to be spending a bit more money making sure that we're providing the best service to all of you that we can. But absolutely going forward, it is very much our intention to just keep driving our fees down. As everybody knows, we're not in this to make any profit ourselves, and so therefore we'll be keeping the lid on things and hopefully passing on the benefits of scale to everybody over time. Any plans to diversify your asset allocations to crypto or gold or anything else we're seeing promising growth in? I'd be very interested in your views on this, Shamubeel. We've never really discussed it, haven't had a chance yet. From our point of view, probably no is the first answer. The one issue which we've stated many times with any of the cryptocurrencies is just the complete lack of regulation. There's lots of other philosophical reasons we could come to, but that's the one which is going to take a big change before we would even consider it. And as far as hard assets like gold are concerned, because they don't actually generate any return themselves, they're extremely risky, and so generally we don't see that sort of investment as part of our KiwiSaver asset allocations. Do you have any sort of further comments?
Yeah, so the way I do my own personal investments is that my personal investments are very much in indexed funds and in actively managed portfolios. And then I have punting money. And my punting money is what buys gold and commodities and crypto. So I keep those two things very separate. One is my retirement plan, and the other is my fund money. And my fund money is really fun, but sometimes I lose a lot of it.
Okay. And we are not in the business of losing any money for you at all. The government appears to be keen on overseas investment in our infrastructure, etc. How will these profits going offshore affect our economy?
Really great question. And I think the question is probably more around the government is interested in private capital in infrastructure investment rather than foreign investment per se. And I think there's some positives and negatives in that. The positives are very much that KiwiSaver in particular stands ready to invest in infrastructure in New Zealand. So as you know, New Zealand has a huge shortfall of both physical infrastructure and houses. So we do need to start investing a lot more money than we have over the course of the last 30 to 40 years. The reason why we might see foreign investors coming into New Zealand is because they are already confident of investing in these asset classes, which our investors are not yet. So when you think about things like build to rent that Simplicity is already doing, that's something that most KiwiSavers in New Zealand don't do. But pension funds around the world are absolutely practiced at doing it and are sometimes quite specialized in doing it. So we might see a little bit of that coming in. So there is a good in that. We get sophisticated investors with experience coming in. But the downside of that is that not only do they bring the capital and the expertise, but some of the profits disappear. So I don't think we should be too worried about that as the big issue. The big issue for New Zealand is that, yes, there might be some leakage of profits, but what's more important is how are we going to fill those holes in our deficits in infrastructure and housing in New Zealand? And right now, I don't think all the evidence shows we are incapable of solving those ourselves. And that's why we need private capital. But I wouldn't be too negative about thinking it's all going to come from foreign capital. All the moves that I'm seeing around policy changes around KiwiSaver, I think is going to enable us to invest a lot more KiwiSaver money into infrastructure in New Zealand. So if you compare New Zealand versus Australia, we invest, 2-3% max in indirect and physical assets. In Australia, it's close to 20%. So even at current size of KiwiSaver in New Zealand today, we could be spending something like $20 billion in infrastructure if the settings were right. And so I think we are going to see KiwiSaver getting quite involved. And I think that would be a really big positive for New Zealand because it would get rid of all the political shenanigans we see in policy, in project choices and delivery and all those other problems that we've all known about for a number of years.
And generate decent returns for our investors. That's obviously key to that as well. These projects can be highly profitable and great for the country as a whole. When do you think the real estate market will pick up in the price of selling?
Yeah, well, I'm going to tell you that economists are terrible at forecasting, particularly when it comes to the future, right? Isn't that a Yogi Berra quote? But essentially, the current situation, as I said before, in terms of the residential market, is we've got conflicting forces: falling interest rates, increased lending for banks, but falling migration. The base case for me is as the economy starts to recover next year, we will start to see both sales volumes and prices starting to pick up. But don't take it as a strong prediction because I've been wrong pretty much every time I've made a pick about house prices.
I think we all have one way or another. But certainly the general consensus appears to be from the sort of broader market is that at least from here things should settle down and hopefully stabilize at the very least. Off piece. Is that Donald? Have you got time to tell us about the artwork in the background? I'll do it very, very quickly. These are photographs taken from an aircraft back in the 50s and 60s, I believe, and then hand painted. I'm trying to think of the name of the entity that did them. It's somebody aviation, and they're all of New Zealand, around the place. Can't really work out which ones you can see, but they're great, and we've got them all the way around the wall here. Thanks for the question. What's coming up next for Simplicity in terms of new funds initiatives? I'm glad Sam's not here. I'm able to say at this stage nothing new. What we want to do is settle down a lot of the stuff that we've got in place already. Although, as Shamubeel has alluded to, there's definitely a reasonable amount of talk about us trying to look to things like infrastructure lending, spending, when we can, but when those opportunities arise. But at this stage, there is nothing new on the horizon. Gerald, great to see Simplicity involvement in long-term rental housing. With that long-term view in mind, are you considering opportunities to invest or collaborate with the Maori economy? Again, a great question, and it has come up quite a few times. And we have had some very broad discussions with iwi over the course of the last 3 or 4 years. Not surprisingly, given our ethos, we tend to find quite a lot of common ground. So therefore, yeah, certainly not ruling it out, but nothing actually is firmly on the plans at the moment.
And certainly, I think it will fit neatly under a private equity mandate currently in terms of the way that we might be able to do it should those opportunities arise.
Yes. If World War III happens and the incoming president, what are the likely impacts to our investments? I mean, it is a great question, and obviously we watch developments in the US with phenomenal amounts of interest. I remember when he was president for 4 years previously, it was never a dull moment in terms of the headlines. Difficult to say. Any thoughts?
No, look, wars are extraordinarily uncertain, mainly because it depends on if the war is contained or it's contagious. It depends on whether it's having really big impact on production of food, production of commodities, and things like that. But the reality is that we are grappling with something much bigger regardless. So whether it's Donald Trump or not, the reality is that wider geopolitical context of the world has become less stable. We're seeing more hot wars, we're seeing more conflict, and we're seeing less cooperation. And that means we are going to see much more variable, returns and many more shocks than we're used to. I was at a presentation yesterday, I was at a conference yesterday, and Tim Grosser was speaking at it, and he said, welcome to the new reality. You've just lived through the calmest period in history, and we're back to the old history. And I feel like that's true. And if you look back at financial market returns in those periods, it's not that the average returns are that different. What is different is the variability of those returns is much higher. So I'd encourage you to think about it more in terms of risk and volatility rather than in terms of necessarily what it means for your retirement savings. But from a wider perspective, I think it behoves us to be more aware of what's happening out in geopolitics, out in the world. But also, I'd encourage you to not get too depressed because reading too much news at the current time is quite depressing.
Can we please move to have a policy that allows drawing a nominal top-up dollars to an MSD benefit if we are over 60 but less than 65? That sort of feeds very much your...
Yeah, it's a really hard one because KiwiSaver was very specifically set up as a retirement plan, and as a result, it doesn't allow you to draw out your savings until you're eligible for the super. But we do have, I guess, hardship allowances and things like that, which are in very extreme circumstances. I think it's an area that we need to have a much better conversation around, is where is it suitable for people to have access to their money sooner, if that's going to make them better off than having to wait for retirement. Unfortunately, that's not yet in the policy mix. It's something that we will revisit because I think we need to have a conversation about what does the next state of KiwiSaver look like when there are some people who should be using KiwiSaver not necessarily as retirement savings, but as precautionary savings.
Yeah, it's an interesting subject. Sort of feeding back to the last question, in a way, is what's your view on the future trend of New Zealand dollars versus US dollars? Yeah, it's a very interesting question in the context of the US elections. Any strong thoughts?
Well, not strong thoughts. Andrew and I've been we sit next to each other at the office, and we've been talking about this a lot. And we've been talking about this a lot because essentially we know that currently, at least, the relative growth prospects in the US are better than New Zealand. So the New Zealand dollar should weaken. But if some of the policies that Trump has talked about are brought to bear, like tariffs, like some of those big changes, they might be very inflationary and quite bad for the US economy. And then the US economy should be weaker and also be riskier. But the US is the risk-free currency, and the reserve currency. So it's kind of this weird confluence of events. And my sense is that at least for the next 3 months or so, the New Zealand dollar is weaker. But beyond that, it's open game in terms of what might happen.
Yeah, and as Shamubeel says, we've talked about it quite a bit already because the US dollar is seen as the least risky currency in the world, probably apart from maybe the Swiss franc. And yet, what's going on in the States, what looks like it will be going on in the States in the next, let's say, 2 years at least, is hardly riskless. So very, very interesting. I wouldn't want to predict where the New Zealand dollar will go in that context because we are relatively reliant on the US in so many ways ourselves. But certainly it's going to be an interesting ride. Question from YouTube. Re Women KiwiSaver and inequality. Is it time that employer contributions by employers are more fairly calculated at a set amount more fairly calculated as a set amount for everyone as opposed to a percentage?
Yeah, that's a hard question. I think from a conceptual perspective, it's likely to remain a dollar amount. But one thing that I'd really like to advocate for is moving away from the 3+3, the employer plus employee contribution. I think like Australia, we should move entirely to an employer contribution, which is, say, 6% of your gross pay. And that should remain that way and grow over time like Australia has done towards 12% now. Whether we should have a kind of a dollar amount, I'm quite resistant to that in a way, and resistant to that because then it becomes quite complicated. I think one of the beauties of KiwiSaver right now is it is quite simple. It seems to work really well, and it's quite linked to the individual's choices and abilities. But yes, absolutely something we should be thinking about, but perhaps better achieved via the billion-dollar subsidies that we use at the moment. Those $1 billion of subsidies at the moment are given equally to everybody. I think we should be using it in a much more, I guess, discrete fashion for people who need it.
Great question, though. Now, this one's anonymous, and it's a long question, and I'll read it fairly quickly because they've answered their own question at the end. Any plans to be able to split KiwiSaver funds between fund types, or ideally introducing satellite type funds that you can have a bit of exposure to alongside the set ones? Would be great to have more control and choice, like some of your competitors are doing, but understand if it probably comes with costs. And unfortunately, whoever. That is absolutely the case. We've got a tremendous administrator. We outsource that function to a company called Apex, who support us brilliantly. But we also negotiated a really good deal with them in the first place. And one of the conditions of that was that we only have a single fund per member. If we were to try to renegotiate that, it does add quite a lot of complexity. And so I suppose all I could suggest is that you try and invest outside of KiwiSaver in the sort of, and you can get whichever of the funds you want outside of KiwiSaver as an adjunct to your KiwiSaver investments. But right here, right now, again, I'm afraid no, it hasn't been discussed, and it would come any complexity, unfortunately, adds cost. Do you have views on how managed retreat can be handled effectively in New Zealand to minimize potential negative economic impact?
Great question. And I won't try to answer it here because it's a really big question. I'd recommend you have a look at this great resource that Motu has put together quite recently on how to get community engagement and support for adaptation. So Motu they've done some fabulous work that's based on not just literature and theory, but they've also gone out and talked to the communities about how to do it well. So please have a look at that stuff. It's really good resource. And I think one that builds on quite a lot of thinking that's been done by people like Jonathan Boston over the last few years. So that conversation is progressing. And I think it's absolutely possible in New Zealand. We can do it in New Zealand because we're still a small country. We have pretty good social cohesion. We talk to each other. We're able to do this. Those are the preconditions. And I think we just have to be deliberate in doing it.
Great. Now, I have to say thank you to a number of people, a few anonymous. Paul, thank you. A number of anonymous, all noted that what I'd forgotten was White's Aviation. Thank you. Shamubeel, you're getting fan mail already. Are you planning to build any units in Wellington in the near future? We say we, of course, Simplicity Living, not us. But at the moment, well, no, more broadly, Simplicity Living are looking across the country at opportunities that may come up. Right here, right now, most of the opportunities appear to be in Auckland, and that's where we're concentrating. But absolutely, it's the intention that Simplicity Living has developments across the country. Wellington's quite difficult because land's so much more constrained. Auckland, actually, land's not the issue up here. I know Wellington creates issues. We've looked at Christchurch, we've looked at Queenstown, we've looked at Dunedin, Invercargill, Tauranga. At the moment, the economics make most sense up here, but in future, absolutely, we will be looking across the country. Next one's a very broad and very important question. What will climate change mean for investments? I don't know if you're aware, but every year now we have to produce what's called a climate statement. We've just produced the first one. All fund managers have to, which actually goes through what impact climate change is likely to have on our investments, and how are we addressing that? So it's a complex question. The impacts are almost universally agreed are going to be negative overall, and it's just a question of trying to limit that impact as far as is possible. I don't know, Shamubeel, if you've got any comments on that, but fundamentally, it's a front of mind question, and we are working very hard to work through over the course of the next 20 years what climate change is likely to mean for our investments, where we should be focusing. We, as you know, I'm sure, don't invest in fossil fuels. There's a lot of things we don't invest in to try and minimize the carbon output. But anything you want to add?
From a more macro perspective, I guess we know with climate change, we're going to have a lot more volatility and a lot more risk, both in terms of economies, financial markets, but also in terms of societal upheavals. So, for me, it's the investment thesis doesn't change. It just means that we just have to be really careful about making sure we understand what we're invested in and going into it with our eyes wide open, because the reality is climate change is an existential threat for humanity and something that we all have a responsibility to work towards. And right now, things are looking quite uneven. Certainly with the political changes in the US, some big uncertainties around climate policies. But one encouragement I take is so much of the gains in, I guess, carbon emission reductions in recent decades has happened in spite of government leadership. So we have seen quite significant moderation in emissions in many industries, and very rarely because of government intervention. So it's still possible that we'll continue to make progress, and we might see that showing up in parts of our financial markets as businesses that are doing great things. But similarly, I think we'll see businesses that are going to be hurt by climate change. That's inevitable.
Absolutely. Do you have any news regarding open banking? I don't have any news. It's something we're keeping a very close eye on, because we believe that's something we will be able to very successfully access when it's available.
Absolutely. So I heard Mr. Bailey speak about it at the Payments New Zealand conference yesterday, where I was also speaking, and he is impatient to get on with open banking. New Zealand is 10, 15 years behind everybody else. We need to have open banking in New Zealand, not because of just open banking, but because it's also about us getting access to our own data, so then we're able to live our lives with less complexity and being less beholden to organizations like particular banks. So open banking, I think, is going to be one of those things that's going to start with consumer data, then open banking on top, and then I guess the innovation of new suppliers coming in to help us really kind of work with the tools that we need for ourselves. So I think New Zealand is actually on a path finally of getting on open banking, and I'm really, really hopeful that the legislation and the regulatory settings the government is working on right now will put the right things in place, because we do need that desperately for New Zealand. I want us to have access to better services, cheaper services, because right now we're paying too much for very little innovation.
Right. Yeah, it was just as an aside, interesting article I was reading yesterday talking about how New Zealand was the pinnacle of innovation in banking back in the 90s, and now what is that? It was a great analogy. Talked about it being a rugby team in a regional, the third grade regional. They were the All Blacks, and they're now in a third grade regional contest.
Our FPOS network was ahead of its time and absolutely brilliant.
Right. Great question here, and it's something which I cannot remember where we got to, and I'm going to have to go back to as soon as we leave here. Is how about your investment account minimums? They're really high, which makes it hard to afford in the current economic climate. And I know shares is virtually zero. Great question. I can't remember what the answer is. It was difficult. It does come back to that cost question that we were talking about previously, but I'm pretty certain that we were working on the idea of reducing those minimums for individuals in particular. And so let me give me a watching brief on that one. I will get onto it. Why do you not use Invest Now? I think that means that we're not available through Invest Now. Not sure how that would work. Again, have to look into it. I don't think there's really any reason why we would want to be, because it's so easy to get to invest with us already. So I'll find out. As a self-employed person, I only contribute just enough to be qualified for the government's $521. Do you think it's best to invest in one go or spread it over the year? That's an interesting one. I mean, the reality is, in my opinion, and it's very much a personal opinion, you're best spreading it out and just investing a small amount regularly, because there is always the chance that you might invest on the one day the market drops 10%, which would be rather unfortunate. So throughout your life, basically, doing small incremental investments is generally the best answer.
I think, yeah, because that $1,043 is not a large amount, it's really up to you. But I think what's really important is if you're a self-employed person, please make sure that you've got alternative retirement savings that you're doing as well on top. So yes, it's absolutely the logical thing to do to have the minimum amount in your KiwiSaver, and that's the right thing to do. But that is not going to cut it when it comes to retirement savings. So please make sure you are investing regularly in other pension or retirement products that will set you up for retirement success.
Yeah, great. Very good point. Now, we've come to the end of the questions currently. Very happy to, I think we allocated it now. So we are very happy to answer any more if anybody's got them, or we'll allow you to go off and get some lunch. But thank you very much for the questions. And that was a tremendous range of questions. I've got a couple of things to go to. And yeah, what's for lunch? Good question. Thank you very much. Let me make sure this isn't a question I need to answer. No. Great. Well, look, thank you all very much, as I say, and we'll close this down now and see you again soon, I hope. Cheers for now.
Thanks, everybody.